This is the future of finance.
This episode is brought to you by Metis Global Partners. Hi, everyone. Welcome to the Future of Finance podcast. I'm Georges Dyer, and today we have another in our series of sessions from the Intentional Endowment Network's virtual forum held back in June. This one is a panel focused on climate change, capital, and fiduciary duty, and it is a conversation between Kirsten Spalding, Vice President of the Investor Network at Ceres, John Adler, Chief ESG Officer for the New York City Retirement Systems, and Machel Allen, President and CIO of Metis Global Partners. They explore how institutional investors can advance climate action through responsible capital allocation. Kirsten talks about the evolution of net zero portfolio commitments in light of the recent political backlash and how investors are focusing in on how addressing climate risk in their investment process aligns with fiduciary duty and can be used to maximize returns and reduce risk. John talks about how 3 of the city's 5 pension funds have committed to net zero portfolios by 2040, and how these goals are rooted in fiduciary duty and the recognition of climate change as a systemic financial risk. He discusses how they work with their asset managers on these topics and requires them to have their own decarbonization plans. And Machel talks about how integrating climate-aligned strategies must be paired with strong financial performance. For clients to stay on boards, returns must be competitive and improve as portfolios evolve to lower emissions. It's a great conversation with views from asset owners, asset managers, and the NGO perspectives. So I hope you enjoy it. Please let us know what you think, and be sure to click follow on your favorite podcast platform and subscribe to our YouTube channel. And now here's Kirsten, John, and Machel.
I'm so delighted to be with you all. Thank you for having us. As we kick off this panel, I thought I'd open with just a couple of reflections on what I'm hearing from the institutional investor members of Ceres Investor Network. We're a nonprofit, but I specifically manage a network of institutional investors, both managers and owners, who work on climate, human rights, water, biodiversity, issues of sustainability, but really with a focus on how it is investors can act to transform global capital markets. What I've been hearing in the last 6 months is that 3 years ago, there was the launch of a whole set of net zero initiatives where investors, both owners and managers, were making commitments and saying, we're really going to try and address climate risk and opportunity in our portfolios. And we're going to lay out targets, how we're going to decarbonize the portfolios, how we're going to invest in climate solutions, and we're going to have plans for how we're going to get there. There's been a lot of backlash, I think, to that from our political arena. There's been lawsuits and investigations, a lot of rhetoric about how those kinds of commitments might not be in the interests of beneficiaries and clients. And I think generally those people who made commitments say that's not true. Absolutely. These commitments were a way of addressing fundamental risks and seeking investment opportunities that are going to produce good returns. But with that backlash, I would say the rhetoric has now changed. And so the investors I'm talking to are saying things like, it's back to basics. We're just looking for good investments. We're addressing material financial risks. You don't need to mention all of the other issues. You can just say that's what we're really focused on. So the focus has become much sharper on what are the plans? How are you addressing these risks asset class by asset class? There's more focus now in terms of climate on adaptation because extreme weather events are real. It's not something that's far away or theoretical. It's not just that we're looking at the predictions, but we're experiencing real weather impacts, physical risks on companies in the portfolio, and investors are really trying to address those as best they can. So we've got 2 terrific investors here to talk to you about their experiences, the kinds of things that they're working on, and how it is they're really situating work on climate in the context of their obligation to, in John's case, the pension beneficiaries, in Machel's case, her clients, and their interests. So why don't I start by turning it over to you, John, the New York City Office of the Controller has done a lot in the last few months, and in particular, we're eager to hear about your call out to your managers.
So I work for the New York City Controller, who is investment advisor for the 5 New York City public pension funds. 3 of those 5 funds adopted a goal of achieving net zero by 2040 in 2021. And they did that because they believe that their fiduciary duty requires that we address the systemic risks of climate change. And so the focus of these net zero plans is on real world decarbonization, not just decarbonizing our portfolios. Our funds are completely externally managed. And one of the key planks in the board's plans was that they set expectations that all of their public markets asset managers would adopt their own net zero or decarbonization plans, at least for the assets they manage for those boards, by June 30th of 2025. So at the end of this month now. And I'll just say that for private markets, they expect that all the funds in which they will invest starting that date or a year from now for one of the boards should have a decarbonization or net zero plan for those private markets funds. Again, the focus of these plans is real world decarbonization. And many of the managers, as we engaged with them on this, tried to sell us net zero products. Like, you want to be net zero, we'll put you in our net zero fund. And that's not what we're looking for. We don't want managers to change what they're investing in. We want them to engage with the portfolio companies that they are investing in to bring about real world decarbonization by using their investments to get those portfolio companies to take concrete action to reduce their emissions, scope 1, scope 2, and material scope 3 emissions. So again, the focus across asset classes is on portfolio company engagement, not reweighting, not tilts, anything like that to make the portfolio look good. Not about what we look like, it's about the world that we live in and the threat that climate change poses to the economy on which all of our funds depend for making investment returns. We've set clear expectations for the asset managers. They in addition to the engagement, we want to incorporate material climate change related risks and opportunities in their investment decision making. And we want to ensure that they have a robust and systematic stewardship strategy that addresses prioritization. In other words, focus on the companies that have the highest emissions, and that they have a plan for escalation of engagement and proxy voting to advance decarbonization. So we have about 80 public markets managers. Our funds in total across the 5 systems have about $280 billion in assets, lots of managers. So we've been meeting with them intensively, really, I would say, since last year to answer their questions about these expectations. We are being very flexible with them about how they carry out their decarbonization mandate, how they report. We're suggesting that they use one of the frameworks that's out there, like the Net Zero Investment Framework or Science-Based Targets Initiatives or TPI. And in private markets, there's the Private Markets Decarbonization Roadmap. But we're not being prescriptive. You must do X, Y, and Z. We're looking for them to have a plan that includes the prioritization and escalation of engagement. And then we're going to be asking them to report on the percentage of financed emissions in their portfolio that are in each step of the framework that they choose. So aligned, aligning, preparing to align, so on. What percentage they're escalating, what percentage they're engaging on, what the results of the engagement have been, how they're escalating, and so on. So again, we're trying to be very flexible with the managers, but the point is that we want all of our managers pulling in the same direction towards decarbonizing the real world that is the portfolio companies that they have opted to invest in pursuant to their investment strategy, their asset class, and so on. And recognizing, by the way, that, different asset classes and strategies have different levers. So obviously fixed income managers don't vote proxies, and control investors have more ability to influence their portfolio companies than non-control investors. We take that all into account. And again, flexibility, but firm on this is the objective that we're all trying to reach. I'll stop there.
Thanks, John. Let me turn to you, Machel, and then we'll get to some questions from our audience. But is what you just heard from John, is that consistent with what you're hearing from your other clients? And what are you doing about that kind of a call from some of the owners you work with?
Yes, in some cases, we're seeing other allocators approach their portfolios that way. I would say that what John is describing is a pretty holistic approach, which is encouraging, as opposed to just kind of a Band-Aid approach. Our role typically with our clients is in regards to their public equity markets, and most specifically in the passive or indexed portions of their public equity portfolios. And what we've seen in many cases with our clients is that this is an entry point for climate alignment from a financial perspective, i.e. with their portfolios as opposed to operationally. And the reason for that is often because it represents a larger part of their portfolio. It's not uncommon for the passive part of a portfolio for an institutional organization to be, 20 to even 50% of the total portfolio. And so the ability to apply a consistent methodology to climate aligning and carbon reduction to such a large swatch of their portfolio at a quite low cost is typically appealing. And so we've worked with, in many cases, our clients' consultants to help wed that goal and what their mission and values and the way they think about decarbonization being effective with a way to systematically implement that, i.e. an index methodology that will capture the majority of what it is that they're trying to do. And we've seen a lot of movement in that area in the last 3 or 4 years. And I've actually, not surprisingly, gotten questions in recent times, in the last 6 months or so, saying, hey, are you seeing any pullback in this area with clients kind of maybe putting the brakes on those plans? We have not. About 60% of our client base is foundations and endowments. And for those clients who have been either exploring that or doing that, we've seen no pause in that work, and we continue to see demand. And I think that's probably reflected even in our ongoing product development. We're actually about to release another new product in the sustainable space, indexing space, a sustainable real asset index fund. So at least from our perspective at this point, the demand continues to be robust.
Yeah. I think, that points, Machel, to this idea that the foundations and endowments, in many cases, are the leaders in this space. They have values orientation, and they're prepared to just, stick to what matters to them as they make their investment decisions. So that's good to hear.
Yeah, no doubt about that. And I just to add a little extra color there, because I do think there's, as we all know, additional considerations, particularly when the monies are public's monies, and I'm sure John can speak to that. But we're seeing it even with our healthcare, our sub-advisory. It's not, you're absolutely right. The ENFs are at the nadir of it. But in private money in general, we haven't seen a shift yet at all, which is encouraging.
This episode is made possible by Metis Global Partners, a global equity solutions provider managing over $5 billion. Metis offers both active and customized beta strategies for institutional investors. Through their guided beta product suite, Metis provides custom passive equity solutions to clients desiring sustainably aligned equity and real asset portfolios combined with a high-touch partnership. Founded in 2013 in San Diego, California, Metis serves a wide range of institutional clients, including foundations, endowments, nonprofit, university, public plan, corporate, and family office clients. To learn more, visit www.metisgp.com. That's metisgp.com, or email info@metisgp.com.
Do you want to say anything about John's approach, which is really focused on the engagement side, on the real economy decarbonization? How is your firm addressing that call for we've got to do something to affect the entire system?
Yeah, that's right. Well, beyond just running the portfolios, I think in order to offer a comprehensive climate aligned solution to a client, that has to include stewardship, that has to include proxy voting as well, and be really intentional about that. And so we do integrate all of that into our standard proxy voting policies. And I think most clients expect that as part of that solution. Stewardship is an interesting space here. We talked about this a little bit as speakers when we were preparing for this, but the big stick factor is very relevant in this. And that's why an organization like Ceres is so great, because you guys can create a network that people can come to and collaboratively create a bigger stick for that conversation. When you're a boutique shop, often that's tough to do on your own. And so I think that's an area where boutique shops, if you're not BlackRock, for example, are looking and beginning to find those solutions. But it's an area that needs a lot more intentional creation around it, I think, to do it well. So,
yeah, thank you for that. It is one of the reasons why all of the global investor networks, Ceres among them, created Climate Action 100 Plus and really established a focus list and an opportunity for the smaller managers and smaller owners to come together, have a shared set of priorities, and engage the company in dialogues, or letters, or roundtables, so that we begin to see that real economy decarbonization. John, for you, there were a couple of questions in the chat. One is, you mentioned focus engagement with companies to decarbonize. And the question is, are there any companies or sectors that you think just can't decarbonize because their core business just prohibits it? And how do you think about that?
Well, yes, of course. It's hard to see how oil and gas can decarbonize. And the reality is that the New York City Retirement Systems, the three funds divested from fossil fuel reserve owners. They voted to do that in 2021, and we completed it in 2023. We still have some energy exposure, not upstream oil and gas, but other energy exposure. And so you can somewhat decarbonize on the margins there, but clearly we have to move away from oil and gas. So I would certainly say that. And then there's others where we're going to need the technology. A lot of transportation is very difficult to decarbonize until, for example, we can manufacture enough sustainable aviation fuel to take coast-to-coast flights that don't involve fossil fuels. So, certainly there are a lot of those. That isn't to say they can't get to zero, but there are certainly steps and measures they can take. For example, reducing methane emissions in natural gas transportation. Right. There's a lot of that. There are a lot of measures that companies can take and are taking to reduce their exposure, their emissions. But obviously, eliminating emissions in some cases is going to take development of technology that we don't have at scale at this point in time. So that's for sure.
Yeah. And I think, as you mentioned, John, there are these technological shifts that have to happen. And what I'm hearing from some of the private market investors and the specialists, especially, that, there are real investment opportunities in scaling those technological shifts that will help us move those hard to move sectors. So it's both risk reduction in terms of,
and that's one of the things in private.
Right.
Yes. Yeah. And one of the things in private markets is that there are a lot of investment opportunities to scale up those let's say, technologies that are proven at a small scale but have to be commercialized.
Right.
And we are seeing a lot of those opportunities in private markets, sort of in the later stage or venture early growth capital phases.
Machel, you talked about some of the strategies that your clients are asking for. When you launch new products, as you've suggested, do you ever hear concerns about financial performance or fiduciary duty when you're suggesting this kind of alignment that really matters to those who have those values?
Yeah, well, I think the right word is expectations of performance, right? Maybe as opposed to concerns. I think unequivocally the expectation is that the strategies that we develop are consistent with the returns expected in the asset class.
Right.
And so it's a double solve, right? You basically need to solve for a portfolio and methodology approach that is evolving in new ways and is different which previously was, but has the same performance or better of what previously was, right? There really isn't a lot of space or expectation, rightly so from a fiduciary perspective, to have substandard performance. So whenever we're creating new methodologies or custom strategies, that's always a requisite to have a successful outcome.
I see a good question from Christopher Rowe from the Church Pension Group. John, he asks, what do you do if managers don't demonstrate progress? And have you had the occasion to let go any managers, or how are you thinking about, making sure that you make progress here?
Yeah. So great question. Our deadline that we set 2+ years ago is June 30th, 2025. So in about 3 weeks. So all of our managers are submitting plans, or I hope they're all going to submit plans. And what we have said is if there are managers that either don't submit plans or submit inadequate plans, then the controller's office, we're investment advisors to the board. So we would advise the board to consider putting those managers' mandates out to bid. And that is what we'll do. It won't be we're not playing gotcha. So, if a manager submits a plan that we consider to be inadequate, we'll iterate with them, we'll give them feedback and hope that they get to a place that we're all, like I said, pulling in the same direction. But if some either won't, or just, won't submit a plan, then we are going to, the plan is to recommend to the boards that they put them out to bid. There's a lot of managers out there that in these mandates, we put, pretty large sums of money to work. There's a lot of managers out there would like to have those mandates. And I think there's a lot that will do it with a climate orientation. So that's where I hope we don't have to do that, honestly, but that's what we'll do if we have to.
You've said a couple of times, John, that what really matters is, are you pulling in the same direction? And I know that I was hearing from members of my network a few years ago, net zero by 2050. That was the measure of, are you going in the same direction? I think I'm hearing now a little bit of softening about that. There is a recognition that we may not hit 1.5 degrees on the timelines we'd hoped. And so some of the funds are beginning to say, look, we've just got to do everything we can to address the systemic risk, but we can't set arbitrary targets because we're not sure we're going to be able to make them. So how are you dealing with that tension there?
Well, let me just say, so we set a goal, again, this is 4 years ago, of net zero by 2040. And we did that because the science at that time showed that if the global economy achieves net zero by 2040, we have a 2/3 chance of keeping overall global temperature rise to 1.5 or below. And if we wait until 2050, it's only a 50-50 chance. I think those numbers have changed today because, as you say, we're either approaching or perhaps at or above 1.5 already, sadly. So a lot of managers said to us, do we need to be net zero by 2040? And the answer is no. Again, we want you to be focusing on net zero. Most of them, if they have a net zero goal, it's 2050. That's perfectly acceptable to us. The challenge for us, which we are not addressing right now. Right now, the goal is to get everybody pulling in that same direction. At some point, we're going to have to go back and say, okay, let's say they're all pulling towards 2050, but we have this 2040 goal. How are we going to bridge that delta?
Mhm.
I don't know the answer to that as we sit here today, honestly.
Right.
But that is something that we'll start to face in the next year or two once we are sort of all moving in that direction. We do have some managers that do have 2040 goals. And we have other managers that aren't setting a net zero goal for the reasons you just said, Kirsten. And partly there's first of all, there's a lot of sensitivity because of the anti-ESG pushback. And there's also a lot of sensitivity because of the crackdown on greenwashing.
Right.
And so managers don't want to say we're going to be net zero by 2050 and then, demonstrate how they prove that or whatever. So that's tough too.
This episode has been brought to you by Metis Global Partners. Thanks for tuning in for the Future of Finance podcast. We hope you found today's conversation insightful and inspiring. Don't forget to subscribe or follow us on your favorite podcast platform. And please take a moment to rate, review, or share the show. All of this really helps us to reach more people like you who care about creating a thriving and sustainable future. And it's a really easy way to have a big impact. So please do follow. A quick disclaimer, the content of this podcast is for informational purposes only and does not constitute investment advice. Investments and strategies discussed may not be suitable for all listeners. Please consult a financial, legal, tax, or accounting professional before making any investment decisions. References to managers and funds are for informational purposes only and should not be considered endorsements or investment solicitations. This podcast does not monitor fund performance or guarantee the accuracy of third-party materials or statements. This has been an episode of the Future of Finance podcast, exploring how finance can shape a vibrant and sustainable future. Thanks for listening, and we'll see you next time.